Good day, fellow investors. Today we are looking at Unilever. Unilever is a defensive brand-rich FMCG, which is short for fast-moving consumer goods, company with steady demand and strong cash flows. Wide but tested, powerful brands and scale advantage remain key. In transition, it's a turnaround play. Early actions look positive, but execution will decide success in the long term. From a margin of safety perspective, the upside is sort of limited. They have a stable dividend, and which is also resilient due to its anti-cyclical nature, but valuation leaves little room for error. It's a fan favorite of big institutional pension funds. So Unilever is a large global consumer goods company with a portfolio spanning food, home care, personal care, beauty, and well-being. Some recent strategic moves include its spinning off of its ice cream business, like Magnum and Ben&Jerry, into standalone entities. Also, it has planned divestitures of non-core food assets in Europe. It is focusing more on high-margin categories, beauty, personal care, and premium brands. In H1 2025, actually, Unilever achieved underlying sales growth of around 3.4%. Basically, half volume, half price, and a nice gross margin of around 45%. You will see on their growth later on the valuation side. Because Unilever sells everyday household goods and personal care products, it tends to have a relatively stable demand, even in volatile macro environments. So that's also why they can borrow more. You will see that on the valuation, their debt levels, and their being favorites of pension funds who like the stable dividends. Although they have some risk, right? And from an investor perspective, actually, this is a business with predictable cash flows. It goes back to the pension funds, not a high growth tech story. And the long track of dividend payments also benefit them. Strong brand. And Unilever owns dozens of well-known global and regional brands. They create loyalty, allowing for really important pricing power and reduced churn. Many analysts, like Morningstar, cite this as a core moat for the business. Being huge gives bargaining power over suppliers, so that's also, you may know that Walmart has over its suppliers. Distribution, advertising, production, and logistics. So scale helps. This helps costs control and entry barriers for new competition. But Unilever also reaches markets all over the world, giving it penetration in emerging and developed markets alike. The portfolio mix and diversification with a wide mix of categories helps buffer against weak performance in one segment, let's say food against personal care. Pricing power, margin resilience. So in many branded consumer goods, companies can pass on input costs to some degree to consumers, preserving margins. Some commentary expects actually margins to expand ahead. Commodization and price sensitivity. So that's one of the main risks for them. So in many regions, consumers are very price sensitive, especially in lower income markets. If inflation is extreme, competitive pressure can intensify, like private labels and local brands, and pricing power will be constrained. So it's not enough to have pricing power. It's not. I mean, the brand is not just like you have it and then you can pass on any price. You have really strong brands like Coca-Cola, and then you have weaker brands which you might substitute for alternatives. Also they have cost pressures, could cost input raw material costs, currency effects, inflation, logistical issues can reduce their margins, but I didn't put in on this list because I think the more important part could be brand fatigue and slow innovation. Long term could erode the market share with new products and failed products. So it goes back to the strong brand. If you look at Coca-Cola, they still innovate. They have a new things come out, but their core brand is still really strong. But that's a really, really rare situation to have a brand like that. Yeah, and maybe we could mention management actually for any company, but even with a moat like this, a company can suffer if leadership makes poor portfolio or capital allocation decisions, which we will see later how it happened actually on the next slide. So if you look at management, they have a dividend. Their dividend policy is to return excess cash. Historically, their payout was like 40 to 60% of net income. They have a new CEO. And management and the board in general is critical when you judge a mature business like Unilever. So, and actually any business, because upside often comes from well-managed investments, cost cutting, and allocations of capital. So the turnover, so in early 2025, Unilever replaced the CEO who had been in the role less than 2 years. So that's pretty fast with the CEO at the time, who effective March 1st. The board said they wanted to accelerate the pace of change and reaffirmed strategic continuity, so the change was framed as a tactical decision rather than a major strategic shift. The new CEO has a long internal history at Unilever, serving in finance. He was ex-CFO, operations, regional leadership roles like in Latin America. Under prior management, there have been critiques. One prominent investor, actually Terry Smith of Fundsmith, publicly criticized management for weak execution, poor acquisition strategy, and underperformance versus peers. Management has committed to a value creation and growth action plan 2030, aiming for improved returns, margin expansion, and general simplification of the business. The company is undertaking cost cutting and productivity programs, for example, 7,500 job cuts and restructuring in recent years. The strategy is to spin off and sell non-core assets, streamline the portfolio, and focus on high growth, high margin segments, which indicates a more active capital allocation approach than we have seen in the past. The new CEO is internal. I think that's really key. Likely has institutional knowledge, which may reduce disruption risk going forward. Management seems serious about restructuring, so cost discipline and reinforcing the business, which is necessary for a mature business like this to achieve any organic growth. And the board is apparently ready to make changes when performance isn't satisfactory, as you can see by replacing the previous CEO. That alignment is positive government signal overall. Although there are some concerns, the short turnover of CEOs, we'll see if this new CEO can make the change necessary in fast enough time. Past criticism of poor M&A strategy, right? Underperformance suggests the possibility of repeated mistakes if oversight is weak. The success of restructuring, brand rationalization, spin-offs, and execution is uncertain. Therefore, execution risk is high, I would say. In a slow growth core business, the margin for error is small. Missteps in capital allocation have an outsized negative effects. And from their performance metrics, their incentive structure, let's look at that, what they are actually using. So I think they have a better incentive structure. I really like the transparency, and I like the incentives they're using. So you have underlying sales growth, right? 40%. They adjust for FX. Underlying operating profit growth, also good. And free cash flow. I really like free cash flow. And then you can see transparently how they link it to the strategy they are trying to pursue. And on the long term, so these were short-term bonus-based, long-term, they are still using sales growth. Important relative total shareholder return. Yeah, I would say if you focus on your business, the share price will take care of itself, but okay. Underlying return on invested capital, I'm happy with this. Maybe they could just add the relative shareholder return and make this 60%, because this is really important not to do things that do not make any sense. And sustainability, yeah, even today, after recent changes and shifts in political situations, ESG and sustainability is still there, lingering. So you will see some in these incentive structures. 15% is not much, but overall I really like the focus on the business, and that's really important, not to have bad incentive structure for senior management. On their dividend history and buybacks, you can see that in the purple you have free cash flows coming in. They they grew on a compounded annual growth rate of around 3%, I believe. You can see that they had huge buyback in 2018. Then 2 years no buybacks. They restarted post-COVID, and they are still below what was before the peak. That's interesting. I think that going forward, if you see they have a huge chunk of free cash flow, 10 billion, and then you see the stable dividends, which could be growing actually. You see here more than here, but overall I think the trend will be up with the business growth. The key point, if you add these two up, you end up around like 6 billion, so that's 60% payout if you add up dividend and buybacks. You have room here on the free cash flow side. Let's see how they allocate that free cash flow capital. I would like to see them actually to pay down some debt. So let's jump on the margin of safety and valuation part. Let's start with one. So first of all, I really like the type of business that they don't have to spend too much to maintain the business. So you see that they have free cash flow relative to cash flow from operations at mid-80s percentages. So that means they spend 15% of their only on capex. That's a good business. You don't have to spend too much to just keep the business running. They had a 3.2% compounded annual growth rate since 2018. Using that 3.2% growth as or going forward with the 10% required rate of return, I put their valuation, at least for me, at 45 euros per share. That's actually a bit lower than today's price, as we will see on the stock summary table in a bit. And then you can look at other valuation metrics on the past 7 years and the last years if you just look at the 10% return value. The company is very profitable. So if you look at the return on equity, it's 50% or more even on the 7-year average. But keep in mind that they have a debt to equity of 150, 160%. So return on equity at these numbers may be a bit misleading because you have a lot of debt and not too much equity. So they are using debt to enhance those returns. If you look at return on investment, that's still nice, 13%. That's above average, I would say. And what I really like to use for companies with strong brands is return on tangible assets. So what that means is that you have basically total assets, and on total assets they make 13%. But if you deduct all the intangibles and goodwill, so basically your brands, they make twice that, 26%. So they don't use much real assets to make 26% return. That's a really good profit margin. And look at debt, high but manageable. So high because I prefer companies to have in general less than 50% debt to equity, but it also depends. So if you are looking at cyclicals, they generally tend to have lower debt than a stable company like this consumer anti-cyclical business. You can have more debt because you have more stable cash flows. And also what matters is not just your debt level, your cost of debt matters, and also your maturity and whole debt structure. But look at the cost of debt, 3.4%, a bit higher than the 7-year average due to rates going up globally, or have been going up. Now they are coming down. And their coverage ratio, so how can they cover with their earnings before interest and tax? How many times can they cover those interest payments? You see that on the 7-year average, they've been covering that easier. Oh, of course, they had lower interest rates. But 9 is for a solid, stable business, 9 is more than enough. From a debt perspective, they are fine. I'd like to see less debt. And on the current ratio, current assets divided by current liabilities, they don't cover all current liabilities because their current assets are really rotating quickly. So they are not, I don't know, like gold company that maybe have gold sitting for longer times, and usually they tend to hold more liquid assets on current assets. Overall, profitable and manageable debt. They have a 3.41% dividend yield at these prices. Okay, we saw on the previous slide that they pay out around 60% with buybacks, so dividends plus buybacks of their free cash flow. So they have approximately, with 10 billion free cash flow, they have approximately like 8, if you would divide the 10 billion by the market cap, which I have on the other side, they are trading around 8% free cash flow yield. That's a bit too low for me, but that's something to, the business is really good, so maybe if it goes lower, it's an interesting situation. So there are risks, there are execution risks from restructuring. So a turnaround play usually doesn't turn around. We'll see how this turns out. And then of course the industry that they are in, it's a sluggish growth versus premium valuation. Premium, if you use a 10% discount rate, and sluggish growth, well, they do 3%, so they are like sort of keeping up with general inflation plus some productivity gains. Yes, if growth would be higher, maybe the value could be at market rate today. So let's look at the stock summary table. We have Unilever at the bottom here. Out of the stocks we have so far checked, it's trading around 51 euros. I think it's worth like 45. So that's 12% negative upside. In general, it's a really good business, but a bit too pricey if you want to have higher returns. And then free cash flow yield is around 8%. I hope you like this video. Please subscribe and let me know if you have any ideas and if you want me to check other companies out for you. Thank you. Have a nice day. Take care.